The average appreciation throughout the United States is around 3 to 5%. Now, the average cash flow per rental property is around 200 to about 400 per door. Which one is better? I've actually done both of these strategies and they've both turned out very well for me. We're going to dive in on which one is better. Let's start with appreciation first. So, me and my wife, exactly 1 year ago, we bought a property for $330,000 and it was worth about $350,000. Now, how did I get that that $20,000 worth of equity? We were driving around neighborhoods that we were really wanting to buy in, and we saw a property that it had a coming soon sign in the front yard. What did I do? I wasn't going to wait for this property to hit the market where I would have to go into a bidding war, because where I'm at right now, everything goes into bidding war. Even the house that we're selling went into a bidding war. Anyways, I went up and knocked on these homeowners' door and just asked them, hey, would you take this price? And they said yes. And I knew what this property was actually worth before I even knocked on the door. And I knew that by running a bunch of numbers. And also, their agent was super mad at me whenever they found out that I actually talked to the homeowners, because obviously they wanted to sell the property for a bigger price so they can get a bigger commission. Fast forward a year from now, and that property actually appreciated to $380,000 in just 1 year. Now that's roughly a 9% appreciation gain and $30,000 worth of equity. Whenever we sell this property, that's the profit we're going to get. And if we break that down monthly, that's basically $2,500 we were getting every single month, but we're just getting it in one lump sum. Now, at the same time, we actually bought a property, a cash flowing property, investment property. And, it was at the same time, so that was super risky for us. And what was that doing? That was paying us $500 every single month after expenses. So that comes out to about $6,000 a year. And that $500 a month, I think that was getting us 30% cash on cash. So we got 9% appreciation on our house that we're going to be selling. And then we were getting about 30% cash on cash return, meaning, we put in $15,000 of our own money to buy that investment property, and we were getting about $6,000 every single month out of it. So we were beating that national average by a ton. And by the way, we bought both these properties with the $15,000 I was just telling you about. We bought the investment property and we bought this property that appreciated so well for us. So if you want to learn more how to do that, consider subscribing and turn on bell notifications. So here is what I want to get across to you. We made $50,000 between, buying the property right with $20,000 worth of equity and $30,000 worth of appreciation. And now whenever we turn to the investment property, we made roughly $6,000. Well, you can see the huge difference. You remember, if I was talking to you earlier, is we made 9% appreciation and then we made 30% cash on cash return on this investment property. So obviously you would think that the cash flow is a lot better because it's 30%. Well, not necessarily, because whenever you're dealing with a large amount of money, let's say $1 million home, and it appreciates 10%, that's $100,000. Now, if you get 10% cash on cash return, let's say you put $10,000 down, a cash on cash return would be $1,000. That's the spread. Yes, you're getting your money back at the same rate. Yes, it's the same rate that you're getting, but it's obviously a bigger difference. So that comes out about an 8 times difference, which is, it's life-changing for a ton of people. If you're able to, in a year, pull out $50,000 worth of equity, well, it's basically you just worked another full-time job making about $4,000 every single month. And again, we were beating the national average for cash flow. So this will tell you how powerful appreciation really is. And if you want to know which cities have the highest cash flow, hit that like button and turn it blue so I know to make that video. Here's the thing, appreciation, it works wonders. But whenever you're talking about financial freedom, you want something that's paying you every single month. So this appreciation, it's hitting our bank accounts at the back end, at the very end of the year. So we're having to wait an entire year to see that money. Now with this cash flow investment property, we were seeing cash flow every single month. So we could basically use that money to pay for our car, pay for our mortgage for the home that we're living in. So when you talk about financial freedom, yes, you want something that's going to be paying you every single month. Now, appreciation, that might be a way to skyrocket, your financial freedom journey, meaning you invest in a high appreciation market for the next 2, 3, 4 years. And then after that 4th year, you cash all of it out and then you go and buy cash flowing properties. Another thing with appreciation is if a market corrects, if a market has a downturn, you're going to have to wait probably about 5 years to actually see that money get back to where it originally was. With a cash flowing property, you don't have to worry about that. All you have to do is get a tenant in that property paying you the rent that you want that can cover your mortgage and pay you your certain amount of cash flow every single month. And that's all there is to it. So going back to investing in high appreciation markets first, here's what I want you to do is go live in high appreciation markets. Utilize the 3.5 to 5% down loan options that is available to first time home buyers. And then, if the property is worth $300,000, put down 3.5%. That's about $10,000. You might not have that much, but there's also other high appreciation markets like Orlando, Florida, where you can go live in a property for about $200,000, still utilize the same system, and then cash out in about a year, and you're gonna have about $20,000 to $30,000 coming out in the back end. After that year, sell it and do the same process over and over and over. And by the 5th to 8th year, you're going to be financially free, no doubt about it. And after a year, sell it, move into another property, and then just rinse and repeat. Now, by the 5th to 8th year, you're going to be financially free. You can buy rental properties after doing this method and live a life on your terms. Which strategy are you using? Are you using the cash flow method or are you using an appreciation method? Let me know in the comment section down below. There's going to be a video popping up right here that I picked out specifically for you, and I really think you're going to enjoy it and take a lot of value out of it. So click on that video. Until the next video, I'm out. See ya.